You know that feeling, right? Your inbox is just crammed with business news, all these reports, earnings calls. It's like a constant flood of numbers.
Yeah, it's a lot.
And it's so easy to just sort of skim it, okay, revenue's up, profits are down, whatever.
Mm-hmm.
But sometimes behind those headlines, there's actually a really fascinating story unfolding. Lots of subtle things going on.
That's exactly why we're doing this. Today, we're taking a deep dive into Chipotle Mexican Grill, specifically their latest results for the second quarter, the one that just ended June 30th, 2025.
And we're going straight to the source for their official press release.
Yep. No speculation, just what the company put out.
So our goal here is to cut through all that noise. We want to unpack these numbers, figure out the key trends, and maybe find some surprising insights.
And insights that matter not just for Chipotle, but honestly for the whole food industry. Maybe even how we think about consumer habits.
Right. By the end, hopefully, you'll have a much clearer sense of what's really going on there.
Okay, let's jump in.
Okay, let's unpack this, starting with the big picture, because it's a bit of a paradox right off the bat.
Yeah.
So on the surface, total revenue, it increased 3.0% to $3.1 billion, which, sounds pretty solid. Growth.
It does sound positive, that top line number. 3% isn't bad.
Yeah.
But, and this is where it's really interesting,
Uh-huh.
comparable restaurant sales. So sales at stores open at least a year actually decreased by 4.0%.
Right. So total money coming in is up, but sales at the same places are down. How does that work?
Well, the press release spells it out, that total revenue increase.
Yeah.
Mostly driven by new restaurant openings. They're just building more Chipotles.
Ah, okay. Expansion makes sense.
Exactly. But that comparable sales drop, the 4.0% dip, that was mainly because of lower transactions, down 4.9%.
So fewer people actually coming through the doors of those existing locations, or maybe just visiting less often.
Precisely. Fewer visits overall at those established spots. But there's another little wrinkle in there.
Oh.
Even though transactions were down, the average check size, how much people spent per visit, was up slightly, by 0.9%.
Huh. So fewer visits, but people spending a tiny bit more when they do go. Maybe adding walk more often or getting a drink.
Could be. Or maybe smaller price increases filtering through. It offset the transaction drop just a little bit.
Okay, so it softens the blow slightly. And there was actually some good news tucked away in there too, right? About the end of the quarter.
Yes, that's important. They specifically mentioned a return to positive comparable sales and transactions in June.
So things were looking up right at the end. Suggests maybe some momentum shifting, not just a story of decline.
Definitely suggests a potential turnaround starting, which leads right into what the CEO, Scott Boatwright, was saying.
Right, what was his take on it?
He commented about seeing momentum build, especially as they rolled out summer marketing and, interestingly, as their comparisons from last year got a bit easier. He sounded pretty optimistic about keeping that positive trend going.
Okay, optimistic is good, but how? What are they actually doing strategically to build on that June momentum?
Well, he pointed to a few key things. First, supporting their restaurant teams, giving them new tools, aiming for better execution. That's always crucial.
Sure, consistency matters.
Then new menu innovations, keeping things fresh. Also really pushing their rewards program to get people coming back. And of course, global expansion, taking the brand overseas.
Makes sense. Hit all the bases. What about digital? That's always huge for them.
Oh, absolutely. Digital sales were still a massive chunk, 35.5% of their total food and beverage revenue in Q2. So yeah, over a third of sales are coming through apps and online orders.
Wow, still huge. Okay, so that digital side is clearly critical.
Mm.
Now, let's maybe peel back the layers a bit more. What about costs and margins? How did they manage that side?
Right, because sales are only half the equation. Operationally, there were some interesting moves. Food, beverage, and packaging costs, for example. They actually decreased as a percentage of revenue.
Oh, really?
Yeah, down to 28.9% of revenue from 29.4% last year.
That's a decent improvement. How'd they manage that?
Primarily, they said, from the benefit of menu price increases they took back in 2024, plus some cost efficiencies they found. But, and this is key,
Uh-huh.
that improvement was partially offset by inflation. Especially, they called out steak and chicken costs being higher.
Ah, inflation's still biting. So they're finding savings, but inflation is eating into some of that gain. That's the story everywhere, it feels like.
It really is. It shows how hard they have to work just to stand still sometimes. Now, labor costs, that's a different picture.
Okay, what happened there? Up or down?
Labor costs increased as a percentage of revenue. Went up to 24.7% from 24.1%.
Okay, why was that? Wages going up.
Well, partly, but the main reason they cited was actually the lower sales volumes we talked about earlier.
Oh, right. So even if the total labor bill wasn't way higher, as a percentage of lower sales, it looks bigger.
Exactly.
Yeah.
But here's the counterpoint, which is pretty impressive, actually.
Yeah.
They said the benefit from those 2024 menu price increases, plus efficient labor management, more than offset wage inflation itself.
Whoa. So despite wages going up and sales volume dipping, their management and pricing power were strong enough to overcome the wage pressure.
Seems like it.
Yeah.
It shows some really tight control on the operational side, managing schedules and staffing effectively, even with those headwinds.
That's pretty sophisticated stuff for a fast casual place.
Definitely. And quickly, just to round out costs, general and administrative expenses also decreased a bit, mainly due to lower bonuses and stock compensation, they said.
Okay. So putting all these pieces together, the sales dip, the cost management, the inflation, how did it all shake out for profitability, the margins?
Well, the overall operating margin took a hit. It was down to 18.2% from 19.7% last year.
Okay.
And the restaurant-level operating margin, which excludes some corporate overhead, also dipped to 27.4% from 28.9%.
So despite the cost controls, the lower sales volume ultimately pulled profitability down a bit for the quarter. It really shows how all these different factors interact, doesn't it?
It absolutely does. It's like a complex balancing act. You adjust one thing, it affects three others.
Speaking of strategic adjustments, we have to talk about Chipotlanes. Those drive thrusts seem like a constant success story for them.
Huge success story. And clearly central to their growth plan. Get this. They opened 61 new company-owned restaurants in the quarter.
61. Wow.
And 47 of those, the vast majority, included a Chipotle.
So they're really doubling down on that model. Why are they working so well? I mean, obviously drive-thrus are convenient, but
The press release spells it out. They enhance guest access and convenience, obviously. But crucially, they're also driving higher new restaurant sales, better margins, and better returns on investment compared to stores without them.
so it's not just convenience, it's actually better unit economics for new stores. Makes total sense why they'd push that, especially if traffic at existing stores is a bit sluggish.
Exactly. It directly addresses consumer demand for speed and ease, and it seems to be paying off financially for those new locations.
Okay, so that's a key part of their growth. What about shareholder stuff and looking ahead?
Right. Well, the company definitely seems confident in its own stock. They bought back a lot of shares in Q2,
How much?
about $435.9 million worth, at an average price of just over $50 a share.
That's a pretty significant buyback. Shows they think the stock is a good investment, right?
That's usually the signal, yes. And they still have a lot of authorization left. As of June 30th, they could still buy back another $838.8 million.
Wow.
And that actually includes an additional $400 million that their board approved just back on June 10th.
So they just topped up their buyback program mid-quarter. That's a strong signal of confidence, even with the mixed results we've been talking about.
It really is. Now, looking ahead, their outlook for the full year 2025, they're expecting comparable restaurant sales to be about flat for the whole year.
Okay, so not expecting a huge rebound in existing store traffic overall for the year, just kind of holding steady.
It seems that way. But they're planning to keep opening a lot of new restaurants, between 315 and 345 new company-owned spots for the full year.
And I bet most of those will have Chipotlanes.
You got it. Over 80% are planned to include a Chipotle. They also gave a tax rate estimate between 25% and 27% for the year.
So if you connect all that, the story seems to be manage the existing stores to stay flat, maybe hope for some improvement, but really drive overall growth through aggressive expansion powered by those high-performing Chipotle locations.
That seems to be the core strategy laid out here. Use new stores and digital access to keep the top line growing, even while navigating challenges with existing store traffic and inflation. Expansion is definitely the main growth engine right now.
Okay, so let's try and wrap this up. This deep dive into Chipotle's Q2. Definitely a mixed bag, like you said. A real tension between growth and challenges. You've got that overall revenue growth, but it's really coming from opening new restaurants. Meanwhile, comparable sales dipped because fewer people were visiting existing locations, even if they spent a little more when they did.
Right. But then you have that positive signal from June, suggesting maybe things started turning around towards the summer.
Yeah, that June momentum is key. But it really highlights the bigger strategic puzzle for them, doesn't it?
It does. And what this all means for you, the listener, is maybe thinking about how a big, established company like Chipotle handles this kind of situation. How do you balance pouring money into new stores versus getting more out of the ones you already have, especially when customer habits are changing and costs are tricky.
Yeah, it's a tough balancing act. Despite the mixed results here, you can see their strategy pretty clearly. Keep building new stores, lean heavily on digital and Chipotlanes, and manage those costs like crazy.
Right.
So, maybe the final thought for you is this. In such a competitive market, fast casual dining, which part of that strategy do you think will be most critical for Chipotle's success going forward? Is it the aggressive expansion? Is it doubling down on digital and convenience? Or is it just that relentless focus on controlling costs? Something to think about.